Planning and budgeting. Planning is the process for achieving the targets and objectives. It is setting of goals on the basis of objectives and keeping in view of the objectives. In short, planning is the process of deciding in advance what is to be done, where, how, and by whom it is to be done. Thus, it is basically the process of thinking before doing. Budgeting is also a planning tool for future. Budgets are usually prepared prior to the start of the period being budgeted. The comparison of the budget to actual results provides valuable information about performance. Therefore, budgets are both planning tools and performance evaluation tools. This lesson discusses both of them and issues related to them. It follows from the previous slide that after studying this lesson, you should be able to understand the meaning of planning, explain the nature and types of planning, describe the classification of budget. Every plan is made to achieve some goals in future and decides the necessary steps for achieving those goals. Planning is made for future only. Planning is an intellectual exercise and involves thinking and forethought on the part of the manager. Planning is based on objectives, facts, and considered forecasts. Planning is a dynamic process and can be adjusted in accordance with the need and requirements of the situation. Planning is the foundation of most successful actions of all the enterprises. The future is uncertain and things are likely to change with the passage of time. Planning helps in minimizing the uncertainties of the future. The first and main step of planning is to fix the objectives. It helps in coordination by setting the goal clearly. Planning and control are inseparable in the sense that unplanned action cannot be controlled. It enables an enterprise to discover new opportunities, which gives it a competitive edge. Planning should have clear objectives. Objectives should be clear, specific, concise, definite, and accurate. The flexibility states that the management should be able to change in plan due to change in environment without any extra cost or delay. The stability means that the basic feature of the plan should not be changed due to change in extreme factors such as population trend, technological development, or unemployment. A plan is said to be comprehensive when it covers each and every aspect of business. It should integrate the whole plans so that the overall goals can be achieved. Financial planning relates to the monetary aspect of the concern. On the other hand, non-financial planning relates to the physical resources of the concern. Planning in black and white is known as formal planning. Informal planning is only thinking about it and doing nothing. Short-range planning relates to a period of less than 1 year. It is to accomplish objectives in near future. Medium-range planning covers the period of more than 1 year but less than 3 years. A planning between 3 to 5 years is known as long-range planning. Standing planning are permanent in nature and are meant to be used over and over again. They ensure quick decision and action whenever the need arises. On the other hand, ad hoc plans are generally for specific purpose and prepared only when the need arises. Planning is generally done at various levels of management like top level, middle level, and lower level. Administrative planning associates with middle level managers and provides guidelines to operational planning. On the other hand, operational planning associates with lower level of management and deals with actual execution of operations. Top-level planning is concerned with fixing of objectives. Budget is a statement of financial affairs or quantitative terms of an activity for a defined period to achieve the enlisted objectives. Budgeting is the course involved in the preparation of budget of an activity. Budgetary control contains two different processes. One is the preparation of the budget and another one is the control of the prepared budget. According to ICMA England, a budgetary control is the establishment of budgets relating to the responsibilities of executors to the requirements of a policy and the continuous comparison of actual with budgeted results, either to secure by individual action the objectives of that policy or to provide a basis for its revision. The screen shows the various types of budgets in practice. The preparation of the production budget is mainly dependent on the sales budget. The production budget is a statement of goods. How much should be produced? It may be in terms of quantities, kilograms in monetary terms, and so on. The methodology of production budget includes three different components, viz. Sales, closing stock, and opening stock. Sales has to be added with the stock of the year at the end and to be deducted from the opening stock. The purpose of the closing stock to be added is that it is a stock at end of the year end out of the current year production. Materials or purchase budget takes place only after identifying the number of finished products expected to produce to the tune of production budget in meeting the needs and demands of the customers and consumers during the season. In order to produce to the tune of production budget to meet the market demands, the raw materials for the production should be maintained sufficient to supply them without any interruption. Sales budget is an estimate of anticipation of sales in the near future prepared by the responsible person for the sale of a product by considering the various factors of influence. Sales budget is usually prepared in terms of quantity and value. Sales overhead budget is one of the important sub-functional budgets prepared by the sales manager who is responsible for the sales volume of the enterprise to increase through various devices or tools of sales promotion. The sales overhead can be classified into two categories, that is, fixed sales overhead and variable sales overhead. Fixed sales overhead is the expenses incurred for promoting the sales, which remains the same or fixed irrespective of the volume of sales. For example, salaries to the sales department administrative staff, salary salesmen, advertisement, and so on. Variable sales overhead is the expenses incurred for the promotion of the sales, which is varying along with the volume of sales of the firm. For example, sales commission, agent's commission, and carriage outward expenses. Cash budget is nothing but an estimation of cash receipts and cash payments for specified period. It is prepared by the head of the accounts department, that is, Chief Accounts Officer. Fixed budget is a budget known as constant budget, never registers the changes in the preparation of a budget being prepared for irrespective level of output or production. This budget is mainly meant for the fixed overheads of the firm, which are constant in volume irrespective level of production. Flexible budget is prepared for any level of production as an estimate of statement of all expenses. That is, the expenses are classified into three categories, viz. Variable, semi-variable, and fixed expenses. The structure of the budget for any output is only to the tune of the actual performance achieved. Immediately after the completion of functional or departmental level budgets, the major responsibility of the budget officer is to consolidate the various budgets together, which is a detailed report of all operations of the firm for a definite period. The zero-based budgeting or ZBB considers the current year as a new year for the preparation of the budget, but the yester period is not considered for consideration. The future activities are forecasted through the zero-based budgeting in accordance with the future activities. Traditional budgeting is accounting-oriented with an emphasis on how much, while zero-based budgeting emphasizes on more decision-oriented with an emphasis on why. The very first step to prepare zero-based budget is to enlist the objectives. The extent of application should be decided in the next phase of the ZBB. The next important stage is to prioritize the activities. The most important step involved in the process of ZBB is cost-benefit analysis. The final step is to select, approve the decision packages and finalize the budget. Zero-based budgeting acts as guide for the management to allocate the resources more accurately, depends upon the priority for an effective implementation. It enhances capability of the managers who prepares the budget for future action. It paves way for optimum utilization of resources available. But it has to be remembered that non-financial matters cannot be considered for the cost and benefit analysis. Difficulties involved in the process of ranking of the decision packages. It needs more time span for preparation, and cost of operations is more and more. Now let us check if we have understood the various concepts discussed in this lesson clearly. The sales budget is a statement of goods. How much should be produced? Right or wrong? Wrong. Cash budget is a statement prepared by the organization to identify the future needs and receipts of cash from yester activities. Right or wrong? Right. Production budget is mainly meant for the fixed overheads of the firm. Right or wrong? Wrong. Before we end, let us briefly revise what we have studied till so far. Budget is an estimate prepared for definite future period, either in terms of financial or non-financial terms. Budgetary control contains two different processes. One is the preparation of the budget and another one is the control of the prepared budget. The production budget is a statement of goods. How much should be produced? The ultimate aim of the production budget is to find out the volume of production to be made during the year based on the sales volume. Sales budget is an estimate of anticipation of sales in the near future prepared by the responsible person for the sale of a product by considering the various factors of influence. The expected increase or decrease in the sales volume should be incorporated at the time of preparing the sales budget from the yester period's sales figures. Cash budget is nothing but an estimation of cash receipts and cash payments for specified period. It is prepared by the head of the accounts department, that is Chief Accounts Officer. It is a budget known as constant budget, never registers the changes in the preparation of a budget being prepared for irrespective level of output or production. This budget is mainly meant for the fixed overheads of the firm, which are constant in volume irrespective level of production. Zero-based budgeting is one of the renowned managerial tool developed in the year 1962 in America by the former President Jimmy Carter. The zero-based budgeting considers the current year as a new year for the preparation of the budget, but the yester period is not considered for consideration. The future activities are forecasted through the zero-based budgeting in accordance with the future activities.